And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Monday of a brand new week in November, and of course, first full week of November. And of course, as we saw last week, markets had a really sharp rally, and this was after the Fed kind of basically gave a more dovish outlook to the economy. Then on Friday, much weaker than expected employment report, and that really started to pull yields down, gave stocks a big boost, and again, the dollar also weakened in this. And there's been a much more highly correlated set of assets in the market. Stocks, bonds, the dollar, and the inverse of the dollar have been very closely correlated over the last couple of years. So kind of so goes those assets. They kind of all been running together, which has made it difficult for investors to find a safe place to hide because everything's moving in the same direction at the same time. So, but nonetheless, the employment report on Friday, interesting because there's been a very long streak of employment reports beating estimates. Like every month that comes out, and we went for like 17 months straight with the number actually beating the estimates. The economists were just wrong month after month after month after month. Well, yesterday we did not on Friday, the employment report not only did not meet estimates, but actually came in much weaker than estimates. And that's a much different tone. 150,000 jobs created, much weaker than expected, of course. But this is something we've kind of been expecting for a while. It's just been taking a while to show up. Now, importantly, we've had the longest streak of data points. And again, so two things that have been coming out. First of all, the number that's been beating estimates. We had a very, very long streak of the actual employment report beating estimates. We've also had an exceptionally long streak, the biggest on record, by the way, of seasonal adjustments that have been adding to the employment report. And that ended this last Friday. So again, it's just been a very interesting set. The data's been coming in a lot stronger than expected. We've also had a lot of seasonal adjustments providing to that those beats. And so the question is really has the employment been that strong? Or is this something that in the future we're going to come back and re-revise those seasonal adjustments and find out that employment's actually been a lot weaker? But nonetheless, we'll find that out later. But this is why, there's always never a recession in sight until there is. And this is why, when you take a look at the employment data, the GDP report, whatever it is, it says, oh, GDP is very strong. It's always strong. We're always running at about 2% economic growth just before we find out we're in a recession a year later. So, because again, we always look back when the actual dating occurs. By the time the National Bureau of Economic Research dates the recession, we always have to go back about 12 months, 6, 9, 12 months, say, oh yeah, it started then, because now we've revised the data and that's where we can see that it started. So again, be careful with the data just because it says one thing or the other, because again, we won't know what that data means until 6 to 9 months from now. Now, importantly, that brings up another point, the lag effect that we've been talking about for quite some time. The lag effect takes roughly about 6 quarters, so 6 to 9 quarters, somewhere around there. That's about how long it takes before that's reflected into the economic reports. We are just now reaching, from the first rate hike, we are now just reaching that point of that kind of 6 to 9 quarter delay. So again, probably sometime first quarter, second quarter of next year, that lag effect is going to start catching up. That's something also that the Federal Reserve has been talking about really at the last couple of meetings. They have mentioned repeatedly the lag effect. They are aware this lag effect takes time. They're aware that all these rate hikes that they put into the system is going to take time for them to show up. And again, we're starting to see that in some of the data. We're starting to see that potentially in some of the consumer spending. And we're going to get a lot more to look at here this month. Obviously, Black Friday, right around the corner. That's coming up on Thanksgiving, which not just a couple of weeks away. It's almost turkey time. So, we'll see what the holiday shopping season kind of kicks off, even though Black Friday started like 2 weeks ago. But Black Friday, I'm already seeing Target has Black Friday specials going on. Sign up now and get Black Friday. Black Friday's the day after Thanksgiving, right? We're not there yet, but we're already having these sales going on. But nonetheless, we're going to get a look at retail sales, kind of really what's happening. Is the consumer hanging in there? Are they still spending money? Then, of course, we've got Christmas, New Year's, all that coming up, right? So over the next couple of months, we're really going to get a good look at just how strong that retail spending is and just how strong the consumer is. So let's talk a little bit about the market rally on Friday. Here's what you need to know before the bell. Market rallied very nicely last week. S&P was up about 6% last week. Now remember, just the week before, we're all in a panic because of this decline in the market. And we were talking about, hey, be careful here. Markets are deeply oversold. We're going to get a rally. If that triggers a buy signal, that's good. And again, in just last week's trading session, 5 trading sessions in a row, markets rallied 6%, completely reversing that break of the 200-day moving average, took out the 20 and the 50-day moving average. So all those resistance levels we were worried about going up, market just ran right through there, with not much effort. This also went right across other asset classes. We'll get to in just a second here. But look, markets are now back to overbought here on a short-term basis, so expect a little bit of a consolidation here. Here's what's going to be important. We may not hold this 50-day moving average, but if we can hold the 20-day moving average and not retest the 200-day moving average, that would actually be fairly bullish. But again, a bit of a pullback here won't be surprising. We're also breaking out, and this was something we talked about last week, is that we have this kind of downtrend channel that the market was building, and market actually broke out of that on Friday as well. So again, lots of kind of good bullish backdrop here to stocks here short term. Markets look to be pointing up a little bit this morning. We might get a little bit of follow through here. But again, overall, we just triggered that buy signal from a fairly low level. So a little bit of consolidation here, not surprising. We kind of hold around this 4,200-ish level. And then the market potentially can make another move higher heading in towards the year end. We'll see. Bonds, of course, is the one thing that everybody's been kind of focused on as of late. Obviously, bonds have had a very tough year this year. Markets were making a nice rounded top in the markets again. Yields moved very quickly last week on that employment report. Came down, retested support at the 50-day moving average. Now, again, this is yields, so it's the inverse of bond prices. Yields came down, triggered that sell signal. So again, that suggests that we're going to get lower yields, but again, probably not right away. So kind of expect a rally in yields back up to about 4.7, 4.8%. Certainly won't be surprising. If the markets can do that, not go above 4.8, and then come down and then take out these lows that we've been setting here over the last kind of couple of months. So again, a bit of a rally here. Markets come down, take out this neckline. That's a very nice head and shoulders top for yields, suggesting that yields are going to go lower. Again, yields right now, short-term oversold. So again, that's what I'm saying. Kind of expect a bounce in yields. Might even see some of that today. So bond prices come back a little bit, give you another shot to maybe add a little bit of bond exposure to your portfolio. But if we start seeing much weaker economic data as we get into the first year, then you would expect to see potentially lower yields here, particularly as inflation starts to come under pressure. But one thing we'll talk about this morning is that lower yields are actually a problem for the Fed. That's what you need to know before the bell this morning. When we come back from the break, we've got a couple of things to get into. The death of fire, as well as what these lower yields potentially and why they are potentially a problem for the Fed. So again, lots of stuff to get into this morning. Stick around. More of the Real Investment Show coming up right after the break. Get to the website, realinvestmentadvice.com. We have our latest newsletter is out, talking about the potential for this rally that we've got in the stock market, all the details behind that. Also, our latest blog post out on Friday, talking about those retail sales and employment numbers, not really as strong as a lot of people expect. So again, that's on the website now. All there for you. It's free. realinvestmentadvice.com. Be right back.
Daily investment news you can use. Delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately, for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Before the break, bonds had a very big rally last week, along with stocks. Again, these are very highly correlated assets these days. Shouldn't be, unfortunately, but they are. The way it's been here for the last year and a half or so, which has made it very difficult for investors, right? Because again, you've really had no safe place to hide, regardless of what was going on. It's like, well, just find me something that's going up in price. Well, it really hasn't been. Small cap, mid cap are going down, large cap's going down. Bonds are going down. So it just really, gold hasn't done anything. It's just gone sideways. So, there's not been really a good safe place to hide in asset classes. And that's, just kind of a function of the market that we've been in as of late. Not much you can do about it, just the way it is. But, that seems to, have been a situation really ever since the Fed started into QT and hiking interest rates. And it's just the byproduct of monetary policy changes, et cetera. It'll end, and again we'll go back to a non-correlated world at some point. It'll just be a function of time till we get there. But this past week, again, stocks rallied, bonds rallied, and this was all in the back of the Federal Reserve. Mostly. And then, of course, weaker economic data on Friday helped really kind of give that boost. And again, a lot of this was short covering. There's such a huge short position out on stocks and bonds. A lot of that short covering was seen in the market. I mean, you had a 6% advance in the market last week. A lot of that was short covering, right? Those shorts being covered. And again, there's not much of that short position in stocks left. Still a big short position in bonds. That really hasn't been reversed much. But while that's good, right, and we've talked about, market was very negative, very oversold. Now, it's in such a dichotomy, right? Because back in June, we're talking about how overbought the market was. Everybody was super bullish. It was FOMO. Couldn't wait to get in to buy, AI stocks. Remember that whole thing? And then in 3 months, everybody's negative on everything. And then now 6 days later, everybody's, all optimistic again. So here we go. But that's the way markets work. It's all about psychology. But, we had this very sharp rally. But here's the problem, and as we've talked about this before. So last week on Wednesday, the Federal Reserve says higher yields are doing the work for us, right? And so there's an equation. If you look out, and the recent run-up in yields this summer was added about 3 rate hikes to monetary policy tightening. And so that was helping slow economic demand and hopefully bring down some inflation, kind of doing the work of the Fed for them. And then this was even a point that the Fed made, and not just Jerome Powell last Wednesday, but that whole previous week, we had speakers coming out talking about how the recent run-up in yields is doing the work for the Fed, and alluding to this fact that the Fed doesn't need to hike rates right now because higher yields are doing their work for them. Well, the problem, of course, is and this is what we talked about before, is financial stability, liquidity, those type of things. The reason that the Fed hikes rates in order to combat inflation is that higher rates slow down consumption. Higher rates impact consumer sentiment, right? Rates cost, everything costs more. And so I'm not happy that things cost more because I can't buy as much. I can't do the things I want. So I stop spending as much, right? So I have less demand in the economy. If I have less demand in the economy, then people that want to sell stuff, they have to discount their prices to sell it to me. And that brings down inflation, because what is inflation? Inflation is just the change of prices relative to demand. So if you have a lot of demand and not a lot of supply, you get inflation, right? Because prices go up. I can charge more for my goods or services. If I have not enough demand and I have too much supply, well, the way I get rid of that supply is what? I put things on sale, all right? And I sell stuff cheaper, and that brings down the cost of prices, right? That's brings down inflation. That's all it is. It's not complicated. It's not some, myth of the world. It's just the difference in prices. So higher interest rates curtail spending, which reduces demand, which means that prices come down in order to get that supply sold. And this was something that even Ben Bernanke, we've talked about this on the show before, back in 2010 when Ben Bernanke did quantitative easing, the second round of it, in September of 2010. He said specifically, I am, basically just kind of regurgitating what he said. It's not an exact quote, but basically saying that the reason they're doing QE is to boost consumer confidence by boosting asset prices. So in other words, the Fed knows that if they do QE, that injects liquidity in the financial system, that boosts asset prices. If I boost asset prices, well, consumers feel better about themselves because, well, they have more money in their bank account. Now their 401k plan went up. Their stock account went up if they have one. Most people don't, but if they do, it went up. And so that made them feel better. So if they feel better, they go out and they spend more money, right? So consumer confidence is the key to all of this. How do consumers feel? Are they confident about the economy or are they not? If they feel confident about their job, they feel confident about their economy, they feel confident about the money they have in the bank, then they're going to spend more money. They're going to take trips. They're going to buy cars. They're going to do whatever they're going to do. That creates inflation. And that's okay, because that's back in 2010, that's what the Fed wanted. We were coming out of the financial crisis. We needed inflation. Market was really stuck in a deflationary spiral at that point, so they needed to get inflation going again. So that was why QE was effective in that regard, by boosting asset prices. The problem for the Fed today is that they still don't want, at this moment, they're still trying to bring inflation down. We're running about 3.7, 3.9% on inflation. That is going to come down next year, regardless. That's just the math. But they're worried about that. And the problem now is that this sharp run in asset prices, this sharp run in bond prices, which is bringing yields down, is starting to work against the Fed, right? It's loosening financial conditions. Now, again, just 1 week doesn't make that big of a difference, okay? But if this continues, if asset prices keep running back to all-time highs, if bond yields keep falling at some point, then that is going to start to run contradictory to what the Fed wants. And this may put the Fed back on to a situation of being more hawkish about their outlook, right? So we're not out of the woods of this back and forth between the Fed and the markets yet, right? So we just saw some weaker economic data. Now, if the data continues to weaken, now here's the other side of this coin. Let's assume for a moment that Friday's employment report was the first domino to fall, and finally this recession that we've been talking about for months and months and months and months and months is finally going to start to rear its ugly head. So everything I just said a second ago is specific to a non-recession scenario. So if yields keep falling and asset prices keep going up, the Fed's going to be in a tough spot with inflation if the economy is avoiding a recession, because that means supply comes back, demand increases faster, and prices go up, right? So that's going to be the problem for the Fed. However, if Friday's employment report was the first domino to fall in a potential recessionary environment, then it's a different situation. Asset prices are going to have trouble going higher because of slower economic growth, which is going to be problematic for earnings growth, right? So all those earnings estimates are going to have to come down. Bond yields are going to fall as money moves into safety, but that's going to be okay because the Federal Reserve is going to be trying to figure out how to bring down inflation interest rates in order to support economic growth as the economy is moving into recession. So here's my point about it. Very confusing, I know. But this is the trap that the Fed has gotten themselves into, and it's not something that is going to be easy for them to navigate themselves out of. Because again, was Friday an anomaly in that employment report? We don't know. And we won't know until we get 4 or 5 more behind us. If Friday's employment report was weak, but then in November we have 300,000 jobs. And then in December we have 400,000 jobs. And January is always a big month because we have a bunch of seasonal adjustments. Then, that's going to be more inflationary, right? So the Fed's going to have to be focused back on inflation. However, if we start seeing a trend of weaker employment reports, the Fed can't hike rates anymore. They're going to have to start worrying about taking the pressure off the economy if employment consistently comes in weak and the threat of recession starts to rear its head. The Fed is going to have to be more concerned about that than not. It's very interesting. Over the weekend, I saw a couple of articles on the website or on the web about Citizens Bank. And apparently, if I can get my computer to work, let me pull up the actual article here real quick. Internet's running really slow today for some reason. Yeah, okay. So over the weekend, I can't find any confirmation of this. And normally, like in kind of the main, kind of financial, like CNBC, for instance, it should be all over the front page, and it's not. But apparently, Citizens Bank failed. And again, there's, a situation here that, we've talked about before, is that, we had those bank failures back in March. And of course, the Fed came in and did the bank term funding program to bail out those banks. Well, apparently Citizens Bank has also, and again, don't quote me on this because I can't find any confirmation. I saw some headlines and I've got some articles in like the Des Moines Register and some others that say, Citizens Bank has failed. But, we'll see. But, one of the issues is that we're not out of this regional bank crisis yet, right? We kind of papered over it, and higher interest rates are certainly causing a problem in that environment. So the battle so back to our original point here, the Federal Reserve is in a really tough spot. Do you keep rates higher for longer and cause a recession in order to bring down inflation? Or does the Fed acquiesce and start to bail out the economy and the financial system despite what inflation is doing, right? Anyway, we'll come back. Talk about this recent death of fire. We'll come back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Bond math is confusing. It's like my wife's girl math. She's convinced that if she buys something at 50% off, she made $50.
The Real Investment Show podcast.
She's now coming up with things about guy math. Every time I buy a new gadget at the house, she's like, guy math. I'm like, hey, yeah, but I save money because I don't have to work as hard. My time is worth money, so I'm saving money if I buy something that reduces my workload at home.
At realinvestmentadvice.com.
Guy math.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, yeah, sorry, I apologize for the slow internet this morning. I was able to find the FDIC notice that came out over the weekend. A Citizen Bank in Iowa, they failed, and they were all the assets were transferred to Iowa Trust and Savings. But the point is, and my point was though, is that these higher interest rates, are taking a toll on the economy and taking a toll on these banking systems. And again, the Federal Reserve is going to bail out the financial system if it gets bad enough. Now, look, small regional banks, that have, 2 or 3 branches and, maybe 100 million or so in deposits, those aren't the big worry, right? It's when you get into the PNCs of the world or the Truist Financials of the world, those, the regional banks that, have a couple hundred, billion under management, those type of things. Those are the systemic ones. And, we talk about JP Morgan, we talk about Wells Fargo as too big to fail. These, big regional banks are also systemically important, right? And they can be shuttered and transferred like we saw, JP Morgan acquiring assets of banks, back in March. That can only go on for so long. And if it keeps spreading, these big banks won't be able to absorb all of those assets. But it's going to be everything's going to be fine, right? I mean, the deposits will be transferred to other banks and you're not going to lose your money, you're FDIC insured, et cetera. Just make sure you're within the limits. But my point though is that when those dominoes kind of start to tumble, the Fed is going to have to give up their inflation fight and start bailing out the economy, right? So they're going to have to cut rates. And that's kind of what the market's starting to figure out now, is that going, hey, look, the Fed's done hiking rates. So the next step is going to be the Fed to cut rates. And the Fed will start cutting rates when the economy's into recession. So that's the point we want to get to. But that's the trap as I said, that's the trap that the Fed's got themselves into. On one hand, they've got this inflation fight. On the other hand, they've got the financial system. You can't fight both fights simultaneously. One's going to win. And my bet is that given that lag effect, you're going to be fighting the economy and the financial system and have to forget about your fight on inflation, at least temporarily. So we'll see. About 3 years ago, I guess, a lot longer than that now, maybe 4 years ago. Time flies when we're having fun, right? There was this whole movement, and we wrote several articles about it and talked about it here on the show a good bit, talking about this financial independence, retire early. It was the FIRE movement. And if you remember, Richard Rosso and Danny Ratliff talked about this as well on Financial Fitness Friday. But, the theory is that there was all these kids that were running around, and they were like retiring in their 30s, and they'd save up, $300,000 in the bank. They go buy a van, they live down by the river and just go travel around and, have their money invested in the markets. As long as they were making 8% a year, they were fine, right? They could live in their van down by the river and have their money coming in from their passive investments, and everything just was going up, and it was no problem. And then the pandemic set in. And of course, all those assets that they were invested in, a lot of cases, they had invested in Bitcoin because it was just going crazy, and they'd invested in a lot of individual stocks that were going crazy at the time. They were making a ton of money, so yeah, they could feel like they quit their jobs, and they went to go retire in their 30s. And one of the problems that we said was going to be the case then is that here's the problem with retiring too early, is that you lose a skill set. The world passes you by, right? You've been out of the workforce for 2, 3, 4, 5 years while you've been early retired. And now you want to come back and get a job because you've run out of money or things didn't work out the way you planned. And everybody goes, well, you haven't been working in 5 years, right? Why do I want to hire you when I've got 60 other candidates over here that want a job, that have, up-to-date skills and, up-to-date talent. So we said that was going to be a problem. The other problem is just the reality that markets don't generate 8% returns every year, right? They may do it a couple of years in a row, but eventually you're going to hit a bad patch. And this is what we said back then. And of course, we hit that bad patch. And it's been a tough couple of years for the FIRE people. And this was something we had said previously. We said the FIRE movement will end badly. The fire will become smoldering embers when something bad happens. It'll fade from the headlines, and it has. You can't. There's no recent headlines on the financial independence retire early movement. It is dead. It is dead, done, over, gone. Now, soft saving is in. It is the new movement for the Gen Zs. This is an article on CNBC this morning, and yes, I'm going to write an article on this so I can bring up my old FIRE articles and we can compare and contrast. Gen Z is taking a more relaxed approach to their long-term financial security. According to a recent study, the so-called soft saving trend is about living in the moment with less emphasis on retiring early or even none at all. So, bad news for Danny and Richard, who are financial planners that want to help people retire early. This younger generation doesn't care about financial planning. They just don't want to retire at all. This is what they're saying now. That will change as they get older. Trust me. When it comes to savings, young adults should not discount the power of compound interest. That is a huge lie, by the way, and we've written an article on that one just recently. There is no compound interest in the financial markets. Anybody who says that does not know what they're talking about. Compound interest is one thing. Compound gains are another thing. Markets do not provide interest. They provide gains. Bond market provides interest. Bond market compounds interest because it pays you a set interest payment every year. You get that interest payment every year, and you have, if you own a bond, an individual bond, not a bond fund, if you have an individual bond, it matures at face value. That is compound interest. Compound gains is assuming the market goes up 8% of every single year. That is not compound interest. That is compound gains, and markets don't do that. If the last 2 years haven't taught you anything, it should have taught you that. So, Retiring early. This is the article. Here's the study. Younger American adults are taking a more relaxed approach to long-term financial security, and this is according to a recent prosperity index by Intuit. In the current climate, newly minted adults between the ages of 18 and 25 are more interested in experiences that promote personal growth and emotional well-being. They are living in the moment, the report found, and they are less interested in retiring early or not at all. Now, look, they're very young, 18 to 25. I did a lot of stupid stuff when I was 18 to 25 years old. When they get into their 30s and 40s, retiring becomes a much more important part of your life because you have now put in the time grinding out a job every day and going, I want to get out of the rat race at some point. But the so-called soft saving trend is the soft life's answer to finances. This is according to the report. Younger adults feel discouraged by the current environment, and putting aside enough money to save for retirement is simply too difficult because it's eating into their ability to live in the moment. So as long as markets were growing up at 10, 12, 15% a year, I could put some money aside and still go do the things I wanted to do and still buy the stuff I wanted to buy. In the last couple of years, that hasn't been possible. All that free money that we got went away. And so now we're back down to the hard realities of life, inflation, the economy, those type of things. And it's simply trying to make ends meet. I was talking to my wife over the weekend about this very thing because, again, just going out to eat is, we talked about this on the show before, it's just very expensive. One of the things that we don't do, we don't go out a whole lot. We mostly cook at home, and because it's just her and I now, for the most of our kids are out. But all of our kids came home. It was my son's birthday this weekend. So everybody came home on Saturday, actually on Friday, and we went out to our favorite Mexican restaurant and took the kids out. And the last time that my wife and I had gone out to eat, somewhere nice, tab was, roughly about $100, something like that. So me and my wife, 3 kids going out. My 4th one lives in Germany, so he couldn't come over for the birthday. But, 3 kids, we go out to eat, tab's almost $300. And my wife and I just looked at each other like, man, it's just crazy how much, how expensive it is. It's amazing. I'm like, I don't know how people do this. Well, then that's the problem that we're in currently in this environment. It's just the cost of everything has gone up so much. But, for younger adults, the inflation factor is eating into the reality of, I want to do these certain things now, my wants, right? I have my wants and my needs. I need to pay my bills, right? I need to pay my rent, need to pay my car note, need to pay my phone bill. And then there's some things I want to do. I want to travel. I want to have these experiences. I want to go hang out with my friends. And I can't do that and save money. So I'm just not going to save money. Now, this is a bad, kind of a bad financial step at that age. We've talked about this before, is that, at that age, you should be saving. Now, I know it's difficult. I know it's hard to set aside those wants in order to fund the need of savings, right? We should make savings a need, that it has to be done, because they do miss the ability, even though the market's in a tough spot right now, it's not going to be this way forever. And if you can buy the market cheaper now and start dollar cost averaging into the markets today, it will pay off. Markets don't compound. Right? There's going to be years that markets don't make money. That's going to happen. We may go through a long stretch where markets don't make money. That's okay. If you've got 30 years ahead of you, you need to be saving and investing into just an S&P 500 index as fast and furious as you can. It'll pay off. But that's hard for people that are young to see that. But I do find it interesting that, 3 or 4 years ago, 5 years ago, they're talking about this whole movement to, be financially independent, retire early in your 30s, get out of the rat race. We said then that wouldn't end well. It didn't. And now the new one is like, well, screw it. I'm just not going to save for savings and retirement at all. That's not going to work out well either. These are not good financial decisions on either end. All right, quick break, come back. Talk about Warren Buffett. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, last week, Berkshire Hathaway, Warren Buffett, reported earnings. Total operating earnings totaled $10.76 billion last quarter, 40.6% higher than the number from the same quarter a period ago. Same period a year ago. I'll say that right. Sorry. The interesting thing is that they are holding a record level of cash at the end of September. $157 billion. Now, it tells you a couple of things. So, first of all, lots of commentary lately about the markets, right? AI and all this type of stuff. And the markets have had a decent correction in terms of valuations last year. They didn't come down much, but they did come down a bit. Warren Buffett is look, let me just step back one second. You cannot invest like Warren Buffett. Okay? You don't have the ability to invest like Warren Buffett. You're a speculator, he's an investor. What's the difference? The difference is that when you buy a stock, hold on, my microphone is having a spasm here. When you buy a stock, you're just hoping the price is going to go up. You have no control over what the company does, how they spend their capital. What do they take out any loans? Do they invest in stupid products or whatever? You don't have any control over that. You're speculating, right? You're buying a stock price today, speculating, hoping that the price will go up in the future. You just hope you bought it at the right price. It's as pure a form of gambling as, betting on a pair of twos in Vegas. You might win, right? Warren Buffett actually invests. And the difference is that, yeah, he buys stocks. But he buys enough stock that he can influence the board. And in a lot of cases, he buys the entire company. Like Geico Insurance. So he goes in and he sits down at the board of directors table, says, okay, what are we doing? And he has a voice, right? And so he has an influence on how that company operates. Has control over how that company operates in a lot of cases. Not in the case of Apple. He owns a huge share of Apple. But He can pick up the phone and call Tim Cook. You can't. Big difference. He also has no time limit. You do. Berkshire Hathaway will be here for 100 years. He won't be. Berkshire Hathaway will be here. So he can buy a stock today and say, I'm going to hold this for 100 years. You can't do that. Why? Because you need your money in retirement. So you're a speculator. He's an investor. Two very different things. But what does $157 billion in cash tell you? That there's not a lot of great opportunities out there. If there were, he'd be making acquisitions. With $157 billion, you can be buying a lot of stuff. He's not buying. You know, he could take that $157 billion and he could throw it into an S&P index, right? He tells people all the time, it's like, you can't pick stocks. Charlie Munger said this, right? That why should you try to pick your own stocks? You don't build your own electric cars or egg beaters. You just buy an index fund. That's the best you can do. Well, why isn't he doing that, right? Why isn't he putting his $157 billion into an S&P index if there's no good opportunities out there to buy? Tells you something about the overall index. Lots of hate on bonds over the last year or so, right? Bonds are terrible. They're only going down. They're never going up again. Inflation's going through the moon, blah, blah, blah. Don't want to own bonds. You know what Warren Buffett has been doing with his $157 billion? Buying bonds. Buying Treasury bonds. At a 5% yield, why wouldn't you? So the thing to take away from this is, look, Warren Buffett is has a proven track record of, managing his company well, building a massive conglomerate of companies, and has built a giant, right? There's no argument of that. But watch what he does with his cash, because that tells you a lot about what his views are on things, right? A lot of concern here over the last, we've written articles about this and we've talked about it on the radio shows, and a lot of bad rhetoric out there about, the reason that yields are going up is because nobody wants to buy our debt, right? So yields are just going to keep going up because nobody wants our debt because of the deficit, and we've debunked all those claims. But if you don't believe us, Warren Buffett's buying treasuries. If he was worried about the solvency of the United States, you think he'd be buying treasuries with his $157 billion in cash? So just again, there's a lot of things you can pin on Warren Buffett. He's said some stuff in the past I don't agree with, and that's okay, right? Nobody's going to agree with everything everybody says. But I think when it comes down, regardless of what his views are or his political leanings, whatever it is, that's irrelevant. Watch what he does with his cash. If valuations were good in the markets, if there were opportunities to buy stocks in the market at this juncture in time, wouldn't he be doing that? Wouldn't he be taking that record $157 billion in cash and putting it to work versus buying bonds, right? If bonds were terrible and stocks were great, wouldn't he be selling his bonds to buy stocks? So again, regardless of what he says, kind of pay attention to what he does. Buyback activity continues to slow down as Berkshire shares awarded to a record high in the quarter. Firm spent about $1.1 billion to repurchase shares, bringing the 9-month total to about $7 billion. So again, it's just something to think about. I did like this, he did kind of hit on some of the risk. While Berkshire scored a sizable increase in operating earnings, the conglomerate did acknowledge the negative economic impact from the pandemic, as well as geopolitical risk and inflation pressures. To varying degrees, this will quote, our operating businesses have been impacted by government, private sector actions to mitigate the adverse economic effects of COVID-19 virus and its variants, as well as the development of geopolitical conflicts, supply chain disruptions, and government actions to slow inflation. That's higher interest rates. The economic effects from these events over the longer terms cannot be reasonably estimated at the time. So that's right. We don't know. And again, as we talked about earlier, the lag effect of those higher rates have yet to be felt in full. Now, they're being felt some, no doubt about that. The extraction of monetary liquidity all of these spending bills, et cetera, that are in the system now, they're going to continue to have an impact on the economy. Like the CHIPS Act and the Inflation Reduction Act, that's going to still provide monetary support to the economy over the next 3, 4, 5 years, right? But it's a much smaller amount over time. So that even that boost that you're going to get from that in terms of economic activity is going to be outweighed potentially by the impact of higher rates on the economy. So again, it's just, the all of that support had to work its way. We wrote the article talking about the pig and the python. All that financial monetary support is still working its way through the python, but we're getting towards the tail end of that. And that support is going to wane more and more over time. And the impact of these interest rate hikes, those are just now entering into the system, right? So those are going to have a much more pronounced effect over time as the monetary policy wanes. And so again, this is the challenge that we're going to face going into next year, and particularly with where we are in terms of a lot of the other economic variables. And again, we've talked about the inverted yield curves, and we talked about the leading economic indexes. The ISM Services Index that came out last week, much weaker than expected. Still in expansion territory, mind you, but weaker. It's not improving. So again, we're still not out of the woods just yet. So this is why we have to remain a bit cautious here. Again, markets were deeply oversold. Still expect a rally into year end. It's going to be choppy. Not going to go straight there. Not going to go back to all-time highs. We get a bit of a pullback here over the next few days, then another rally, then potentially a pullback in the first couple of weeks of December as mutual funds make their distribution. We get the year-end rally, and then once we get into January, I have no idea. We kind of have a game plan of what the markets should do, and that's just from historic trends over the next 2 months. We kind of know what that should look like. That doesn't mean it has to happen either. Seasonal trends and historic outcomes, those are possibilities and probabilities. And, the statistics have, they lean towards the probability side of a continued rally here over the next couple of months. But it's always possible it doesn't happen, right? Anything can happen. We get a bunch more weak economic data. Markets start questioning earnings going forward. So, get by the website, realinvestmentadvice.com. Make sure that you get our latest newsletter. Make sure you're subscribed there. And, of course, get our daily market commentary. That's out every morning. Subscribe to that. We'll get that to you by 7:30 in the morning, get you set up for your trading day. It's all at the website. Best of all, it's all free. realinvestmentadvice.com. Have a great day. We'll see you back here tomorrow.